Let's talk about the debt-to-income ratio. The debt-to-income ratio represents the percentage of your income that goes to paying debt each month. It is equal to the total of all your monthly debt payments divided by your monthly gross income. And remember, your gross income is your income before taxes. Let's look at an example. Let's say you have monthly student loan payment of $400, a car payment of $300, and your gross income is $7,000. Your debt-to-income ratio is the $400 plus the $300 divided by $7,000, which equals 0.1. To convert that to a percentage, you multiply by 100 to get 10%. Now you might be thinking, that's great, but why should I care? Well, first of all, it is good for you to know how much every dollar is going to pay debt. So in the previous example, 10% would be a dime for every dollar that you make. Secondly, this is a metric used by mortgage lenders as well as auto lenders during their loan approval process to make sure your current debt payments plus the new debt payment doesn't exceed your debt-to-income limit. Generally speaking, less than 36% is preferred. However, lenders' requirements do vary. So let's look at an example. If the max debt-to-income ratio is 36%, your monthly gross income is $7,000, then your maximum total debt payments cannot exceed $7,000 times 0.36 or $2,520. Since you already have the student loan for $400 and the car payment for $300, you would take the $2,520 minus the $400 and minus the $300, and that will give you $1,820. This will be the amount of room you have per month to take on additional debt, and the lender would determine the loan amount based on that number. So the lower the debt-to-income ratio, the better. But hold on, just because a lender will approve you taking on the $1,820 per month doesn't mean that you should. The goal is not to take out as much debt as possible. It is just to get only what you need and what's manageable for your budget.